Hello, everybody. Today is chart day here at Zanetti Financial. And yes, we need a hobby if we really love charts this much. But there was some that just jumped out this week, and I thought, you've got to see this because it kind of shows the disconnect between the real economy and the stock market. So let's start with this one from, Isabel Net. I'm not even sure who these guys are. I had never seen this chart before. But it's a chart of trucking tonnage versus the stock market. And I thought that's fascinating. What you're saying is how much tonnage is moving on the roads versus the S&P 500. Well, you see the darker line? That's the stock market. You see that orange line? That's the tonnage. See, this chart goes back to 2000, 2001. And look how it all tracks together. Then in 2020, we have this big divergence. The stock market heads straight up. Meanwhile, the tonnage, you see it kind of flatlines there. Well, I don't know about you, but I think that tonnage is a pretty good indication of what's going on in the real economy. Meanwhile, the stock market kept going up. The question is why? Our belief here is we just printed trillions of dollars during COVID, and that money went disproportionately to stocks versus the real economy. All right, let's go to the next chart. The S&P 500 dividend yield. All right, what is this? Dividends. If a company's got enough profit that they can pay out some of that profit to the shareholders in the form of a dividend, that's a good thing. Now this chart goes back to 1890. Well, that's a pretty old chart. It's not often you have a chart that goes back 130 years. If you looked at the average dividend yield over 130 years has been about 2.4, maybe 2.6%, right in there. Look at this chart. 1.34% is the dividend yield on the S&P 500 right now. That's an all-time low. Well, wait a minute. These companies are doing so well. How come they can't pay out dividends? Where's the cash flow? Where are the profits? It kind of makes you go, All right, let's go to our next chart. The PE ratio. And anybody who talks about PE ratios at a party quickly finds himself standing alone. Trust me, I know. All right, what's a PE ratio? All we're doing is comparing the profits of a company versus the price per share of the stock. Do the profits warrant the price per share? Now, in the old days, we would have said this. A PE ratio between 12 and 15 was kind of fair value. If you went above 15, that stock is really expensive. Are you sure you want to pay for that? If the PE ratio were below 10, you might be thinking, this is a deal. I'm buying a lot of profit for not a very large price. All right, over the course of years, that 12 to 15 has been about the average. Now, do you see kind of that first spike? It's kind of toward the middle of the chart. That's 1929. And the PE ratio hit at the time 30. Oh, that was off the charts. Well, we know what happened. We all know what happened in 1929. Stock market fell top to bottom 89%. Now, do you see the highest peak there as you head across the chart? That's .com, 2000. Yep, that one didn't end well either. That fell 80%. Look where we are today. That little dot there at the far end of the chart. There's a little spike there at COVID. Then COVID knocks the stock market down. Up we're coming again. Right now, we're higher than we were in 1929, but not as high as we were during .com. So the question is, do you want to play chicken with this stock market? Because the PE ratio is now, it's about 34 right now. That's pretty high by any historical measure. All right, next chart. AI. Everybody's been talking about the AI stocks. All right, let's do a comparison. Let's go back to Cisco versus NVIDIA. All right, NVIDIA is the darling stock. We've talked about it here before. It's one of the 4 stocks that's hauling the stock market up. All right, the dark line is NVIDIA stock. The red line is Cisco. back in 1996 to 2000, meanwhile overlaid with NVIDIA 2020 to 2024. Pretty close. Up it's going. Are they the exact same stock? No. Is it the exact same situation? No. But there are a lot of similarities here too. We'll see if NVIDIA holds up, and if it doesn't, you can expect the stock market will show a lot of weakness. And if you don't believe this chart, we'll end with this one. Here's Intel, a local favorite. I love Intel. Everybody loves Intel. We love that they employ all these people. This chart shows Intel stock. Do you see that first big spike, the highest spike in the chart? That's .com. Look how similar that looks to the NVIDIA chart. And then look what happened. Down went Intel. Right now, Intel's at $42.64 a share. It peaked in 2000 at $75 a share. Guys, Intel's a great company. They're still employing people. They're still expanding. They're doing great, but the company is not the same as the stock. Intel isn't back to where it was in the year 2000. It has never gotten back there, and it's been almost a quarter of a century. What I'm saying is this. A stock and a company are two totally different things. You can have a great company that survives decades, but the stock never gets back to where it used to be. We're investing here in what we believe are good investments for right now, and in general, it's not the stock market. The stock market has disconnected from the real economy, and something's got to happen. Either the real economy's got to zoom up, or stocks have to come back down to a more historically normal level. So with that, be right, sit tight. I believe we're in the right investment mix. We've had a very good couple of weeks, and now I'll turn it over to Walt.